What happened over the last few weeks at the Federal Reserve is being quietly overlooked, and that is precisely why it matters. Yesterday, I spoke about the Federal Reserve and the scale of liquidity it has already injected into the system during December. At the time, the numbers were concerning. Now, with the full data published, they are far more alarming. In the first 3 weeks of December alone, the Federal Reserve conducted approximately $46 billion in asset purchases. This was not speculation. It was confirmed through official balance sheet data, released with a delay due to the holiday schedule. The Fed was supposed to publish these numbers on Thursday, but because of the holiday, the update arrived later than expected. What the data reveals is simple but unsettling. The Federal Reserve has now executed the largest monthly expansion of its balance sheet since March 2023. That date should immediately ring a bell. March 2023 was the moment the U.S. banking system cracked. Silicon Valley Bank collapsed, followed by a cascade of regional banking stress. The Federal Reserve was forced to abandon quantitative tightening and step back into emergency liquidity mode, despite publicly insisting that it was not QE, but merely a temporary backstop. Fast forward to December 2025, and we are seeing a disturbingly familiar pattern. The full December figure now stands at $194.83 billion in asset purchases. That means nearly $60 billion was injected into the system in just the final week of the month alone. This matters because the Federal Reserve had explicitly told markets it would limit purchases to $40 billion per month, primarily focused on short-term Treasury bills with maturities of 1 year or less. So the obvious question is unavoidable. Why the excess? Why nearly $65 billion beyond guidance? The answer almost certainly lies in liquidity stress. When central banks exceed their own stated limits, it is rarely proactive policy. It is reactive containment. Something inside the financial plumbing required immediate intervention. And this is where the repo market becomes critical. Under normal conditions, the repo market functions smoothly between financial institutions. The Federal Reserve does not need to step in. Banks lend to one another. Collateral circulates. Trust exists. But when trust disappears, the Fed becomes the lender of last resort. On December 31st, the Federal Reserve injected approximately $74.6 billion through repo operations. That alone raised eyebrows. But the following day, it added another $20 to $23 billion, largely tied to treasuries and mortgage-backed securities. This repo activity is happening on top of the ongoing QE-style purchases. That combination is not routine, it is defensive. It suggests that financial institutions are once again reluctant to rely on each other for short-term funding. And historically, that reluctance only appears when balance sheets are under stress. The natural place to look next is the U.S. Treasury market. Over the same period, the yield curve steepened. Short-term rates remained relatively stable, while long-term yields moved higher. The 30-year Treasury yield is now approaching 5%, while the 10-year yield is pressing toward 4.20%. These are not minor moves. A rise of 4 to 5 basis points in long-term yields over a short period signals increasing pressure on bond prices. When yields rise, prices fall. And when prices fall, the cost of issuing new debt increases. For the U.S. Treasury, that is a serious problem. Every percentage point increase in yields compounds future debt servicing costs. And with trillions of dollars in refinancing ahead, even small moves can have outsized consequences. Technical charts reinforce this concern. The 10-year yield is approaching a key trendline breakout. Meanwhile, the 30-year Treasury bond futures are displaying a classic bearish flag formation. According to market technicians, a break below the 111 level on the 30-year bond future would confirm further downside, meaning even higher yields ahead. This creates a dilemma for the Federal Reserve. Allow yields to rise and the Treasury market destabilizes. Step in with purchases. The Fed quietly re-enters quantitative easing, undermining its own credibility. This tension explains why December's actions look so inconsistent with official guidance. The Federal Reserve may not be announcing QE, but it is behaving exactly as it did during previous crises. The last time we saw comparable balance sheet expansion was during the 2-week window between March 8th and March 22nd, 2023, when nearly $391.5 billion was injected into the system. At that time, the Fed insisted it was not QE. It was merely a temporary facility to stabilize regional banks. So the question now becomes unavoidable. What is the Federal Reserve stabilizing today? Is it the Treasury market? Is it hidden stress within regional banks? Is it leverage inside? While the Federal Reserve's balance sheet expansion raises serious questions about the stability of the financial system, it is not happening in isolation. One of the most revealing signals that something deeper is unfolding appears not in equities, but in precious metals, particularly silver. Before returning to the broader macro picture, it is important to understand why silver deserves attention at this specific moment. In recent days, markets showed resilience on the surface. Gold finished roughly $10 higher compared to the end of last year. Silver gained approximately $1.20. Equity markets were mixed but stable. The Dow gained just under 300 points. The S&P added around 20 points. The Nasdaq 100 lagged slightly. At first glance, nothing here appears alarming, but markets often send their most important signals quietly. Behind the scenes, something critical is happening in the physical silver market, and it intersects directly with the liquidity stress visible at the Federal Reserve. Over the past several months, there has been growing discussion around export controls, strategic stockpiling, and rising sovereign demand for precious metals. Much of this discussion has been dismissed as speculative. However, new information suggests the scale is far larger than most observers realize. According to sources with deep connections inside central banking and sovereign purchasing channels, two regions alone, India and the Gulf Cooperation Council countries, are currently acquiring approximately 55 metric tons of silver per month. That number deserves careful consideration. India, now the most populous country in the world, has a long-standing cultural and economic relationship with silver. It is used not only as a store of value, but in industry, jewelry, and savings across a broad segment of the population. The Gulf states, meanwhile, are increasingly diversifying reserves away from traditional financial assets and into tangible commodities. Combined, these purchases represent a significant drain on the global silver market. Silver is not gold. Its market is far smaller, far thinner, and far more sensitive to changes in physical demand. Unlike gold, much of silver's annual production is tied to base metal mining. It is often a byproduct of copper, zinc, and lead extraction. That means supply cannot easily respond to price signals. If demand rises sharply, production does not follow quickly. This creates a structural problem. When sovereign buyers accumulate silver at this pace, they are not trading paper contracts. They are removing physical metal from circulation. And once that metal is absorbed into reserves or long-term holdings, it effectively disappears from the free float. The free float is what allows the paper market to function. It is what underpins futures contracts, leasing arrangements, and price discovery mechanisms. When the free float shrinks, leverage increases. When leverage increases, fragility rises. This is why silver behaves differently during periods of financial stress. It is both an industrial input and a monetary metal. When confidence in the financial system erodes, silver experiences pressure from both directions. Industrial users worry about availability. Monetary buyers worry about currency debasement. At the same time, central bank behavior reinforces these concerns. When the Federal Reserve expands its balance sheet by more than $100 billion in a single month, it sends a clear message. Liquidity is being prioritized over discipline. Stability is being preserved through intervention rather than organic market function. Historically, this environment favors hard assets. The last time the Federal Reserve injected liquidity at this scale was during the March 2023 banking crisis. That episode exposed how quickly confidence can evaporate when leverage meets rising rates. It also demonstrated that once intervention begins, it rarely stops cleanly. Markets become conditioned to support. Silver ES role in this environment becomes increasingly important because it sits at the intersection of trust and utility. Unlike purely financial assets, silver cannot be created digitally. Unlike gold, it is consumed. Each ounce removed from the market tightens supply permanently. Recycling helps, but it does not offset sustained sovereign accumulation. This is why the pace of purchases matters more than the headline price. A market can remain calm even as structural imbalances build beneath the surface. Prices lag fundamentals until they do not. When the adjustment finally occurs, it tends to be abrupt. This brings us back to the Federal Reserve and the Treasury market. If the Fed is indeed stepping in to cap long-term yields, it implies concern about debt sustainability. Rising yields increase borrowing costs for the government, corporations, and households simultaneously. They strain balance sheets across the system. In such an environment, the appeal of assets without counterparty risk increases. Silver fits that profile. It does not rely on a promise. It does not depend on solvency. It does not require confidence in intermediaries. That is why sovereign accumulation is so revealing. Governments do not buy silver at scale unless they anticipate stress elsewhere. This does not mean a crisis is imminent. It means risk is being repositioned. Markets are adaptive. They respond to incentives. When central banks inject liquidity aggressively while simultaneously insisting inflation is under control, contradictions emerge. At this stage, it becomes impossible to treat the Federal Reserve's actions as isolated or technical adjustments. When liquidity injections, repo operations, and rising long-term yields appear simultaneously, they point to stress in the same place: the U.S. Treasury market. This is the backbone of the global financial system. It is the reference point for risk-free rates, collateral valuation, bank balance sheets, and international reserves. When instability appears here, it does not stay contained. Over the last several sessions, the yield curve has been sending a clear signal. Short-term rates have remained relatively stable, but long-term yields have continued to climb. The 10-year yield is pushing toward a technical breakout, while the 30-year yield is approaching levels not seen in years. This is not benign. Rising long-term yields mean falling bond prices. For existing holders, that translates into losses. For new issuance, it means higher interest costs. For leveraged institutions, it means collateral stress. And the timing could not be worse. The United States is facing a massive refinancing cycle. Trillions of dollars in Treasury debt must be rolled over in the coming years. At the same time, commercial real estate, private equity, and corporate borrowers are all approaching refinancing walls of their own. Higher yields do not just increase costs, they compress options. This is why the Federal Reserve is trapped. If it allows yields to rise freely, bond prices fall further, balance sheets weaken, and confidence erodes. If it intervenes by purchasing treasuries, it undermines its inflation-fighting credibility and effectively resumes quantitative easing. December's data suggests it chose intervention. The scale of QE-style purchases exceeded guidance. Repo usage surged. Mortgage-backed securities were included. These are not routine operations. They are signs of pressure in the financial plumbing. The most telling aspect is not what the Fed says, but what it does. Central banks rarely act preemptively at this scale. They respond to stress already visible inside the system, stress that is often invisible to the public until it breaks into the open. This raises an uncomfortable question. What is currently being supported? In March 2023, the answer was clear. Regional banks were failing. Depositors were fleeing. Emergency facilities were rolled out to prevent contagion. Today, there is no official crisis headline, but the behavior is similar. That suggests the problem is broader, quieter, and potentially more dangerous. The Treasury market is not just another asset class. It is the foundation upon which leverage is built. Banks hold treasuries as capital buffers. Repo markets depend on treasuries as collateral. Derivatives reference treasury yields. Foreign governments hold treasuries as reserves. When treasury volatility increases, everything else amplifies. This is why the steepening yield curve matters so much. It indicates that investors are demanding higher compensation for long-term lending to the U.S. government. That is a confidence signal. It does not mean default is imminent. It means trust is being repriced. At the same time, economic data beneath the surface is deteriorating. Auto loan delinquencies are rising rapidly. Consumer credit stress is spreading. Commercial real estate remains under pressure, especially office space. These sectors are highly sensitive to interest rates. Rising yields tighten financial conditions, even if policy rates remain unchanged. This is how stress propagates. The Federal Reserve finds itself attempting to manage conflicting objectives. It wants to signal control over inflation. It wants to support financial stability. It wants to maintain confidence in the Treasury market. But it cannot fully achieve all three simultaneously. Every dollar of liquidity injected to stabilize markets weakens the inflation narrative. Every attempt to suppress yields undermines price discovery. Every delay compounds the eventual adjustment. This is where precious metals re-enter the picture. Gold and silver are not reacting solely to inflation. They are reacting to confidence erosion. They reflect skepticism toward financial promises. Silver, in particular, is sensitive to this dynamic because of its thin market structure. When trust in paper assets weakens, even modest physical demand can create outsized effects. This is why sovereign accumulation matters so much. Governments do not buy silver because they expect short-term price appreciation. They buy it because it sits outside the credit system. It does not rely on counterparties. It does not default. In an environment where the core of the system is under strain, these characteristics become valuable. The Treasury market's fragility explains why central banks are walking a narrow path. They must prevent disorderly moves without revealing how dependent the system has become on intervention. But markets eventually test credibility. If yields continue to rise despite purchases, the Fed will face a choice: escalate intervention or allow instability. Neither option is attractive. This is why December's actions matter so much. They were not symbolic, they were substantial. They suggest the system is closer to its limits than official narratives imply. Mainstream commentary continues to focus on equity indices and headline growth figures. But equity performance can mask underlying fragility for long periods. Bonds do not lie as easily. The bond market is where discipline eventually asserts itself. And right now it is signaling discomfort. Whether the immediate trigger is Treasury supply, foreign demand, bank balance sheets, or derivative exposure remains unclear. But the response is visible. Liquidity is being added quietly, aggressively. And when liquidity injections coincide with rising yields rather than falling ones, it suggests that intervention is struggling to regain control. When you step back and connect the dots, a clear picture begins to form. What we are witnessing is not a single policy mistake, not a temporary liquidity operation, and not a routine end-of-year adjustment. It is a system under strain trying to preserve the appearance of stability. The Federal Reserve's actions in December were not about growth. They were not about optimism. They were about control. Control of yields, control of liquidity, and above all, control of confidence. Confidence is the most fragile asset in finance. Once it erodes, it rarely collapses all at once. It leaks, quietly, incrementally, And by the time it becomes visible to the public, the adjustment is already well underway. This is why the return of large-scale liquidity injections matters so much. It signals that the financial system has reached a point where it can no longer tolerate prolonged tightening without consequences. The official narrative says the economy is resilient, markets are strong, employment is stable. But beneath that surface, pressure is building in places that matter far more for systemic stability. The treasury market, the credit system, the refinancing cycle. These are not headline-friendly topics, but they are decisive. When long-term yields rise while central banks are injecting liquidity, it tells you something important. It tells you that demand for debt is weakening relative to supply. It tells you that risk is being repriced. And it tells you that intervention is becoming less effective at anchoring expectations. This is the danger zone. For decades, the global financial system has relied on one assumption, that U.S. treasuries are unquestioned safe assets. Everything from bank reserves to pension funds to international trade financing depends on that assumption. Once that assumption starts to wobble, even slightly, the implications are enormous. Higher yields mean higher debt service costs. For the U.S. government, that translates into hundreds of billions in additional interest expense over time. For the private sector, it means tighter credit, lower valuations, and increased default risk. And defaults do not need to explode to cause damage. They only need to rise enough to change behavior. Banks tighten lending. Investors demand higher premiums. Liquidity thins. This is how slow-motion crises develop. The Federal Reserve understands this dynamic. That is why it intervenes early, quietly, and aggressively. It hopes to stabilize the system before stress becomes visible. But every intervention carries a cost. Liquidity injections undermine the credibility of monetary tightening. They blur the line between quantitative tightening and quantitative easing. They reinforce the perception that the system cannot function without constant support. That perception matters. Because once markets internalize the idea that intervention is permanent, behavior changes. Risk-taking increases in some areas. Defensive positioning increases in others. Volatility rises. This is where precious metals enter as a signal rather than a speculation. Gold and silver are not responding to fear headlines. They are responding to structural imbalance. They reflect declining trust in financial discipline. Silver's situation is especially revealing. It is not just an investment metal. It is an industrial input. It has a small, tight market. And it is increasingly being absorbed by sovereign and quasi-sovereign buyers. That combination is rare. When demand from India, the Gulf, and other regions accelerates while supply remains constrained, the system loses flexibility. There is no deep futures market capable of absorbing sustained physical drawdowns without repricing. This is why talk of free float matters. Once enough metal is removed from circulation, price becomes the only adjustment mechanism left. The same principle applies to bonds. When buyers step back, yields rise. When yields rise, costs increase. When costs increase, intervention follows. But intervention cannot create trust. It can only delay its loss. Looking ahead to 2026, the path forward is not binary. It is not collapse versus stability. It is a narrowing corridor. Policymakers must refinance massive debt loads in a higher rate environment. Consumers are already stretched. Credit stress is rising. Commercial real estate remains unresolved. Geopolitical risks continue to add volatility to energy and supply chains. All of this points toward a year where volatility, not growth, becomes the defining feature. Markets may still reach new nominal highs, but nominal is not the same as real. When currencies weaken and liquidity expands, asset prices can rise even as purchasing power falls. This is not prosperity, it is distortion. The key question is not whether central banks can continue to intervene. They can. The real question is whether intervention will continue to work. History suggests that the effectiveness of monetary tools declines as debt increases and confidence erodes. Each new round of support delivers diminishing returns while increasing long-term fragility. That does not mean collapse is imminent. It means the margin for error is shrinking. In such an environment, capital behaves differently. It seeks durability. It seeks optionality. It seeks assets that do not depend on promises. This explains why gold remains firm, why silver demand is accelerating, why physical assets regain attention during periods of monetary stress. None of this requires panic. It requires awareness. The system is not broken overnight, but it is